Chapter 19 explains cost volume profit analysis, or CVP analysis. The chapter objectives include to identify how changes in volume affect costs, to use CVP analysis to compute break-even points, use CVP analysis for profit planning and graph the CVP relations, use CVP methods to perform sensitivity analysis, calculate the break-even point for multiple products or services, and distinguish between variable costing and absorption costing. The first learning objective is to identify how changes in volume affect costs. Some costs, like cost of goods sold, increase as the volume of activity increases. Other costs, like straight-line depreciation expense, are not affected by volume changes. Managers need to know how a business's costs are affected by changes in the volume of activity. Let's look at the three different types of costs. Variable costs that increase or decrease in total in direct proportion to increases or decreases in the volume of activity. Fixed costs tend to remain the same in amount regardless of variations in levels of activity. Mixed costs have both variable and fixed components. They are called mixed costs. Total variable costs change in direct proportion to changes in the volume of activity. An activity is a business action that affects costs. Those activities include selling, producing, driving, and calling. These activities can be measured by units sold, units produced, miles driven, and the number of phone calls placed. So, variable costs are those costs that increase or decrease in total as the volume of activity increases or decreases. Total variable costs increase as activity increases, but the variable cost per unit does not change. For example, direct materials is a variable cost. The more production that occurs, the more direct materials that are needed. The direct materials cost per unit stays constant at, say, $25, but the total direct materials cost increases proportionately with production. This graph emphasizes the direct relationship between production and direct materials costs. As you can see, the total variable cost of equipment rental increases proportionately as the number of events increases, but the equipment rental cost per event does not change. Exhibit 19-1 graph total variable costs for equipment rentals as the number of events increase from 0 to 30, but the cost for each equipment rental stays at $15 per event. If there are no events, the company incurs no equipment rental cost, so the total variable cost line begins at the bottom left corner. This point is called the origin, and it represents 0 volume and 0 cost. The slope of the variable cost line is the change in equipment rental costs on the vertical axis, divided by the change in number of events on the horizontal axis. The slope of the graph equals the variable cost per unit. In Exhibit 19-1, the slope of the variable cost line is 15 because Greg spends $15 on equipment rental for each event. Total variable costs fluctuate with changes in volume, but the variable cost per unit remains constant. In contrast, total fixed costs are costs that do not change over wide ranges of volume. Fixed costs tend to remain the same in amount regardless of variation and level of activity. A company's fixed costs may include depreciation on the cars, as well as the part-time manager's salary. This graph represents fixed costs. The straight blue line shows that fixed costs remain constant regardless of activity. Total fixed cost does not change, as shown in this exhibit, but the fixed cost per event depends on the number of events. For example, if Greg's Tunes performs at 15 events, the fixed cost per event is $800. That's $12,000 divided by 15 events. If the number of events doubles to 30, the fixed cost per event is cut in half to $400. That's $12,000 divided by 30 events. Therefore, the fixed cost per event is inversely proportional to the number of events. Costs that have both variable and fixed components are called mixed costs. For example, a cell phone company charges $10 a month to provide the service and 15 cents for each minute of use. If the cell phone is used for 100 minutes, the company will bill $25. That's $10 plus 100 minutes times 15 cents per minute. The $10 monthly charge is a fixed cost because it is the same no matter how many minutes the company uses the cell phone. The 15 cents per minute charge is a variable cost that increases in direct proportion to the number of minutes of use. This graph represents a mixed cost cell phone. In this situation, the cell phone plan has a base cost of $10 per month, which is the fixed portion. In addition, each call costs 15 cents per call. That is the variable portion. As an easy method to separate mixed costs into variable and fixed components is the high-low method. This method requires you to identify the highest and lowest levels of activity over a period of time. This method provides a rough estimate of fixed and variable costs for cost-volume profit analysis. The high and low volumes become the relevant range, which we discuss in the next section. Managers find the high-low method to be quick and easy, but regression analysis provides the most accurate estimates and is discussed in cost accounting textbooks. There are 3 steps to complete the high-low method. First, variable cost per unit is computed. That amount is used to determine the total fixed cost. Then an equation is created to show the cost behavior. The highest and lowest levels of activity and the related costs for a period of time are determined. To determine the variable cost per unit, the change in cost is divided by the change in activity. The next step is to pick one level of activity, either the high point or the low point, and plug the variable cost per unit in the formula. Then subtract that amount from the total cost for that point. Create and use an equation to show the behavior of the mixed costs. This equation is expressed as variable cost per unit multiplied by the number of units. This amount is added to the total fixed costs. This example uses the highest cost and volume to calculate the total fixed cost. But you can use any volume and calculate the same $1,000 total fixed cost. Using this equation, the estimated music equipment maintenance cost for 400 event playing hours would be $1,800. The relevant range is a range of volume where total costs remain constant and the variable cost per unit remain constant. In other words, the relevant range is the range of events or other activity where total fixed costs and variable costs per unit stay the same. To estimate costs, managers need to know the relevant range. Why? Because total fixed costs can differ from one relevant range to another, and the variable cost per unit can differ in various relevant ranges. Variable cost per unit can also change outside the relevant range. Short exercise 19.1 focuses on variable, fixed, and mixed costs. Philadelphia Acoustics builds innovative speakers for music and home theater systems. Consider the following costs. Identify them as variable, fixed, or mixed. Number 1. Units of production, depreciation on routers used to cut wood enclosures. Variable. Wood for speaker enclosures. Variable. Patents on crossover relays. Fixed. Total compensation to salesperson who receives a salary plus a commission based on meeting sales goals. Mixed. Crossover relays. Variable. Continuing on the next slide, straight line depreciation on manufacturing plant. Fixed. Grill cloth. Variable. Cell phone costs of salesperson. Mixed. Glue. Variable. Quality inspector salary. Fixed. Short exercise 19.3 addresses mixed cost and using the high-low method. Martin owns a machine shop. In reviewing his utility bill for the last 12 months, he found that his highest bill of $2,800 occurred in August when his machines worked 1,400 machine hours. His lowest utility bill of $2,600 occurred in December when his machines worked 900 hours. Calculate, number 1, the variable rate per machine hour, and 2, Martin's total fixed utility cost. Variable cost per unit equals change in total cost divided by change in activity volume. And part B, Martin's total fixed utility cost. The exercise continues on this slide. Martin owns a machine shop. In reviewing his utility bill for the last 12 months, his highest of 28, that was 1,400 hours, and his lowest of 26, which was 900 hours. Show the equation for determining the total utility cost for Martin's. The exercise continues. If Martin's anticipates 1,200 machine hours in January, predict his total utility bill using the equation from requirement 2. Draw a graph illustrating your total cost under this plan. Label the axes and show your costs at 900, 1200, and 1400 machine hours.